Thanks everyone for being here. It's awesome to be down in Melbourne. I'm Raj. I'm an investor at Airtree based in Sydney, but Melbourne's hometown for me, so I spend a lot of time down here. Airtree is sort of one of the older, larger venture capital funds in ANZ. We've been investing since 2014 and have invested in, or also been early investors in companies like Canva, Linktree, Immutable, Employment Hero. We, at the start of last year, raised our fourth series of funds. So we've got a 700 mil total fund size, which was a record fundraise at the time. And that's split across a sort of 220 mil seed fund, which is where we spend most of our time. So about 2/3 of the checks that we write are at the sort of pre-seed and seed stage, about sort of 40-50% of pre-revenue. We also have a sort of 450 mil growth fund, which is there to support companies through multiple rounds as they scale up. And then we have a 50 mil Web3 crypto fund as well. I guess maybe one good place to start, I'd love to just do a quick sort of survey and understand who in the room has raised a seed round, if you put your hands up. Awesome, couple of folks. Who's raised a Series A? Awesome, no one. So we've got lots of people trying to cross the chasm to seed to, oh, sorry, we have one. Awesome. So that's great, helpful for the panelists to understand. Awesome. So we've got a really great panel here today. We've got Buddhi from Sapia, sort of founding team member and chief data scientist. We've got Jess from Neighbourlytics, one of the founders, and we have Jacqui, one of the founders of Sidekicker. So let me just quickly pass over to them and they can give a quick intro and talk a little bit about their fundraising journey.
Thanks, Raj. Hi, everyone. So I'm Buddhi from Sapia, the chief data scientist and one of the founding members of Sapia. So Sapia, with regard to fundraising, we raised a Series A last year, end of last year, from Macquarie Capital and W23, the venture arm of Woolworths. So what's Sapia? So Sapia is a screening tool for high volume recruitment. So what we've done is displace or provide a method without the resume to screen candidates. So we use a chat interview that's scored by AI in the back end. So it eliminates bias and also provides a greater candidate experience. So it is for high volume recruitment. So when you're hiring, when you get candidates over like 1,000 in the numbers, and if you're hiring around 2 to 5%, so that's where Sapia operates. Yeah, that's
awesome.
us.
Thanks, Buddhi.
So I'm Jess, co-founder of Neighbourlytics, and we're a Melbourne-based prop tech startup, and we have built an analytics platform that provides the property sector with the human data that they need to design better cities. You might be surprised to know that often very little data is actually used to put stadiums in the right place or design the right size of parks, and we've found a way to use things like Instagram, TripAdvisor, Google Meets, all these different platforms to look at real time how people are using neighbourhoods and provide analytics for the property sector to track the ROI and plan better things. We've been around for about 6 years, which makes us maybe not really that much of a starting up anymore. But they've been, with COVID and the property sector being all over the place, been lots of up and downs through that time. We've had 4 capital raises, including pre-seed, seed, and then 2 pre-Series A rounds. And so some of the things I can talk about today, and particularly if you've got questions, are around how you think about getting your Series A timing right, because twice we weren't ready for Series A yet, and we intentionally delayed it and took smaller capital instead. So happy to talk about that today.
Awesome. Thanks, Jess.
Hi, everyone. I'm Jacqui. I'm the co-founder and COO of Sidekicker. Sidekicker, we're an online staffing platform. So we use technology to make the process of finding and managing casuals and finding casual work a lot faster, more transparent and more affordable. So in the last year, I think we had about 30,000 workers work across Australia and New Zealand. Some of the industries we operate in is industries where they have a high volume of requirements for casual labour and a lot of seasonality. So I think the retail sector, hospitality, aged care, and we also service a lot of startups actually going through their growth period where they need to scale up their workforces quickly or have flexible kind of flexibility within their workforce to build them up and down as they need. So in terms of our funding history, we're even older as a startup, 10 years, 10-year anniversary last year. And I guess I've been through the whole stage from the bootstrapping, early stage, seed, money from anyone who will listen, friends, family, networks. And really that took us through kind of the first 4 years until we got to the point where we were comfortable to go to market for a Series A. And at the time, we ended up we were talking to VCs and more corporate fund with Seek. And we ended up going the corporate route, and Seek, the jobs platform, did our major investment and then has invested a number of times since then. The latest round was 20 million in 2022. So yeah, I think that early stage seed to A period is a challenging one, but there's lots of different options for people to go for.
Awesome, thanks, Jacqui. And I'm really excited to sort of unpack it. I think we have a great set of panelists because they've each had sort of very different experiences raising and also raising from different types of investors, which is something we'll sort of come back to. I think sort of, so the whole purpose of this panel is to talk about crossing the chasm from seed to Series A. It's probably a helpful place to start to sort of define what we mean by seed and Series A. And these are sort of quite nebulous terms that investors and founders all sort of dance around. They don't really have any defined meaning, but the way I like to think about it is your pre-seed round is typically pure team and dream. It's a couple of founders with laptops and hopefully a pitch deck. And then by the time you get to seed, it's sort of around the time you've probably built your first MVP and you have your first couple of customers maybe paying, maybe sort of free trial type users depending on the sector you're in. And you're maybe starting to generate a little bit of revenue. And a seed round is really there to kind of fund and accelerate your product development. So to take your product from a sort of hacky MVP to something you can actually take to market. And seed rounds, there's ranges for all of these things, but they typically in Australia look like kind of somewhere from 500K to 5 mil fundraisers. The one sort of maybe example highlight like to show you how high they can go is last year Airtree led a seed round for a company called Human, which was a $10 million raise, which at the time was the largest seed round by a sort of all-female founding team. So they can go as high as sort of 10 mil. And then your Series A, the kind of key distinction I think between Series A and seed is really by the time you're going to raise your Series A, you should have pretty strong signals that you're getting a bit of product market fit. And that's the time when you want to go to market and raise a Series A to really kind of put fuel on the fire, as it were, and really kind of capitalize on that customer pull to sort of accelerate your growth. And typically, Series A rounds in Australia, sort of 5 to 10 mil fundraisers can go as high as 20 mil. And they're typically there to kind of grow team, particularly sales and marketing, and maybe enter new markets as well. I'd love to, I don't know if the panelists have anything to add, having all gone through seed and Series A rounds to that, if there's anything I missed.
Well, I think the way that we particularly thought about it, and I obviously agree with your definitions, is that when we were asking ourselves whether we were ready for Series A, it was coming back to, is this the exact model we want to push the accelerator on? Because when we were meeting with investors and talking about what the plan from Series A to Series B is, it's like, okay, you've got your model, and we have a very profitable model, and it is something that could have been scaled. But when we were getting down to the nitty gritty of, is this the one we are scaling, and is this the one we take to the Southeast Asian market and the US market? And we weren't quite ready to say that yet. So for us, that was the important threshold to be ready with before we decide, okay, this is the time to go through that gateway.
Yeah, that's a really good shout. It's really kind of both parties, investors and founders coming together and really aligning on a vision of where the company's going to go from the Series A. And so it's really important to have thought that through deeply. And you are sort of committing yourself to a certain path and getting investors excited on going on a particular journey. And so it's really important to think that through. I'd love to come back to that and unpack that a little bit more. I'm not sure if anyone anything else to add. Otherwise, we can move on to the next question. Awesome. Okay, so kind of pulling that thread a little bit more, let's talk about sort of your seed round as distinct from a Series A round. And I guess the question probably on everyone's mind, or the question that probably goes through every founder's mind is like, how do you know the business is ready? What are the kind of metrics, positioning, how to think about valuation? Jess made a really good point when we were talking yesterday that the time to raise a Series A is not just when you're running out of money. So maybe I can pass over to Buddhi if you want to share a few thoughts on that.
Yeah, that's an interesting question. I think it depends a lot on what you are selling, for example. So there are, the more generic ones like, okay, is it now repeatable? Have you found product market fit? And just general sort of ARR. Some VCs will look for at least around 1 million. So in our case, it was more like we were seeing over the COVID period. So yeah, we had a seed round and kind of a bridging round in between. So we were still, we felt not ready, even though we've reached the 1 million ARR. But, towards last year, we could see that we were able to repeat, and, we found that market where for high volume recruitment, where it's a good fit, for example, retail, call centers, etc. So as we started, accelerating, that's when we felt, okay, this is the time to really boost. That,
And,
yeah.
and to pull that thread a little bit, like what did that feel like when you were going through that phase? When it started to feel like you were getting product market fit? What are some of the things that like maybe sort of metrics you were looking at or things that were happening in some of the sales conversations? Is there any kind of anecdotes you could pull out?
Well, I think there's two sides to it. For example, from a, being an AI company, it's really exciting to see your data grow. That there's a compounding value in, especially for an AI company, the value that you can add to your machine learning when the data is growing. So that's an exciting feeling.
That like reinforcement loop going.
Correct. Exactly. So you can see that, and the customers are getting that value, because you're learning across, all the data that you're acquiring. So that helps boost the value. That also helps in the sales conversations, to show the model accuracies are growing. So that's a positive thing. And I guess the other thing is you can see your CAC sort of stabilizing. The CAC stands for customer acquisition cost. So those are kind of signs, that's telling you, okay, we are at that stage.
Yeah, exactly. So getting more cheap to acquire customers. CAC, you should really think about as your sales and marketing cost divided by the number of customers you acquire in a particular period. That's awesome. Jess, Jacqui?
Yeah, I think the signals that you look for when you're going through the seed kind of capital stage versus Series A are extremely different, which everyone has kind of touched on. For us at Sidekicker, I think seed was very much a fluid time where you had a lot of ideas and a lot of ways you could take your business, and you needed just a bit of runway to be able to kind of test that out. For us, we started more like an Airtasker model, so kind of like pick up my dry cleaning, do my groceries, and connecting people that way. Then we looked at kind of the way our people were using us, and it was in very small numbers, but businesses would actually use us once a week, and for someone to like set up the office furniture or do some data admin. And those little signals were like, oh, okay, we'll try that. And then we'll try and do cold calls to sales. And then we got a job at the Melbourne show to do promo people. So then we like sold to all of the brands. And this is just us picking up the phone, making cold calls, like no strategy, just get out in market, see what happens. And then once you start to see things work, that's when you kind of double down your focus. And that was the story that we were telling our early stage investors. And like Raj said, they're really just backing you and the team and the vision. And I guess when you got to Series A, we had tried everything. So we'd done hospitality, we'd done marketing, we'd done the Expert 360 model, like contractors and fixed price jobs. And we just tried everything. And we ended up actually back pretty much where we started, 3 years prior, which was in industries that had high volume of work and low skilled labor. So hotels, bars, stadiums, that kind of thing. And once we had a good pool of customers and regular usage, that's when we were like, okay, we know this, we can quantify the market size. We know that this is a good product market fit for those customers. We know who they are and how to get them. So we can take that story to investors, which is what we did. And at the time when we raised, Seek was actually looking at their own internal data from their jobs platform and had come to the same conclusion that there was, contingent labor was going to move online, and that the industries where there's a lot of labor moving around and fluctuating is going to be where the growth happens. And it's taken us about 3 years to figure that out. They probably looked at it for like 30 minutes. So that was quite validating when you do start to talk to investors and they get what you're trying to do, and they can kind of corroborate what you're telling yourself with your data. And maybe that might be another topic, but around having that alignment with the investor. You're not trying to convince them that your idea is the right thing and that your market is the right one and that this is where the world is going. They are you're both having that conversation together and going, oh yeah, this is like, we've got to act on this now. And that for me was really important, like that values alignment about where the business is going. So probably just, yeah, the other signal that you mentioned, Jess, is around, I'm ready for Series A when the investors I'm talking to are aligned with what I want to do, not what they want you to do. And if you're still not aligned, then it's best to just hold off and try and bootstrap it for longer until you can get the right investor on board, because going through Series A changes things, and you're in bed with your investors for a long time. So it's important to get it right.
We went through a similar journey from seed to Series A, where seed, the pitch was, between these four walls. I'm not giving you the polished one, but it was like, we've got some really cool tech that no one else can do. We're selling it and making money to these people in property, and there's a ton of other people we can sell it to. Give us some more money and we'll test all those other people. Perhaps that's a bit what you guys did. So then we've spent the last few years learning how to sell it to other segments within property, like other job descriptions, all that sort of stuff, and figuring out where actually the product market fit is best, not where it could be, but actually where's the sweet spot. And the challenge is that the market changes. So because we're a category creator in property, no one was accessing data about humans. They were just talking to people in the street or looking at them and assuming things. The industry is changing because we are in it. And then of course, COVID changed everything for most industries too. So we have to really take it slowly and see how the chips are landing before we make a bet one way or another, which again is why for us, really being super intentional about when the right time for Series A is has been a hot topic in our team.
There's two really nice threads there in the sense that like there's kind of two ways to spin that story. One is that you spent X number of years kind of going down all these different pathways and then realizing that like maybe one of the ones that you thought at the start was the right one, and to look at that as a failure. The other kind of way to spin that is I imagine what you experienced was that when you ultimately settled on one, whether it was customer segment or vertical, I imagine you had a ton more conviction that like this was the right thing to do. Is that a fair assessment?
Yeah, definitely. Because I think when anyone who's in business will know that the hardest thing, well, my view, the hardest thing about a strategy is choosing what not to do, not choosing what to do. So being able to actually just say, nah, doesn't work. Cleaning doesn't work because everyone wants to go off platform and just connect with their cleaner. High skilled roles doesn't work because how I screen a marketing manager and how you screen a marketing manager is very different. And I can't scale that. I can't build out a pool of marketing manager screeners. I could use Sapia, maybe that would work, or a tool now, but 10 years ago we couldn't. So being able to go through that journey, and we were lucky that we had the time, I guess, and we could, because we were taking a margin from the beginning, so we weren't a non-cash generating business. We had the luxury of having those few years to actually figure things out. It wasn't, it was very up and down. It was pretty tough, but and I don't know if now people have that luxury with the VC space growing so much, and it's a different era now. But for us, and then even today, like new starters will still go down straight away down those rabbit holes of where we should expand and what we should do. And we can say we actually tested that out. It didn't work. So let's stick to our strategy.
Yeah, that's so much of like the IP and the DNA of a company that they sort of build up over years and years. And that's really a major source of competitive advantage, all of that like market knowledge, customer buyer knowledge, things like that. So that's another sort of thing that you accumulate on this journey to a Series A, which is where you say, we're going to go down this path for the next 2 years, whatever that number is. Sorry, Buddhi, were you going to say something?
Yeah, I was going to say, especially being a data company and an AI company. So that in that early stage, you have a ton of ideas that you're going to test, because you're like bursting with ideas. Test this, test that, because there's data sets, but that challenge of being capital constrained makes you focus and makes you kind of pick on one or two big bets. It's really about what Jacqui's point around, what not to do. But what to do is also like, it's not easy, but you have to, at the end, pick one or two big bets and kind of focus on that, which is not easy. Because you feel like, am I giving up? Is there an opportunity because I didn't try this path? But then you don't have the capital to do all of that. So you got to do that, and it's not an easy thing, but that's what every founder has to do. You just gotta, okay, this is what I'm gonna do.
And particularly with like running data science experiments, they're sort of notoriously expensive, right? Like data science costs a lot of money. It takes time to acquire the data, build it up, and like run your tests, build models, train the models, and get that feedback and see if it makes, see if there's value in it for the business. Are there any kind of like metrics, North Stars? I know you kind of went through a process of iterating and doing a lot of experiments at Sapia. Are there any kind of like North Star metrics that you used when you were sort of maybe prioritizing or stack ranking these different experiments, like looking at, market size or segment, or, how did you think about maybe revenue potential? Or...
Yeah, that's an interesting one. I think before I go to metrics, I think there are a few challenges you'd face, especially if you're building a data company, like, the cost. But before I go into that, are there any founders here building machine learning based, data science based products? All right, that's
a few
cool.
hands.
That's good. So I would say we faced maybe 3 key challenges. The first one is access to data. So finding the data set initially. You might be working in a domain where publicly available data sets might work, but in our case, that was good to test ideas and hypotheses, but it's not good to kind of build a live product that will put that you put candidates to. The second thing is access to talent. Data science and machine learning talent is extremely expensive, and especially in high demand. So as an early stage startup, how do you attract those good talent? So maybe a hack that we used there was getting access to some of the labs at universities, where you'll find really amazing researchers who are who are nearly finishing or who's finished a PhD or master's by research. And also some of these students have industry experience, so it's a really nice combination. So they are not your typical academic, so they have industry experience. So if you find them, which we were able to find, that helps. So you strike that balance. I think the last thing is access to pilot customers, which is related to also access to data, because if you can find pilot customers who are happy to pilot initially, so that's going to be your early data set. So in our case, our founder, Barb, she had a great network through her past lives. So we were able to kind of use that to get access to few customers early on. And that's how we kind of reached that early data, getting access to early data sets. With regard to metrics, I mean, it's a typical metrics that in any machine learning or any data science product we look for. There are different accuracy metrics, different things like precision, recall. I mean, the typical, are you improving them? Every time you retrain, are you improving them? Are you helping companies convert from, for example, taking the top 10 candidates, how many of those would they hire? Can we help them convert 6 out of 10? Instead of when they were initially doing it, it was like they will call in 10 people, but they'll only hire 4. So you help increase the yield. So those are early signs that the product is working.
We've been through the same set of challenges, and the way that I now realize we accidentally did it right at the beginning is that we intentionally, when we only had 3 staff and one of them was an amazing data scientist, we sandboxed all the time. Anytime a customer said, hey, do you reckon you could do this? Like, yeah, we can do it. And hey, do you think we can do it? We'll have a go. And we had huge overheads for the fulfillment of our orders, but we had an element of customization for most of our users. And we were comfortable doing that because my professional background was being a consultant in the same space, and I was trying to disrupt my own background. So we had the technical ability to do that, but it also gave us a huge knowledge of R&D learnings. And every time we tested it, we have a very transparent way of mapping and tracking our analytic or our product maturity. And it starts off with red, then it goes orange, then it goes yellow, then it goes green. And green means every customer can get it with absolutely full automation. Red means the team have to spend an unknown amount of time to build it. And so we've been the whole way through the company gone, this is great functionality. We built it red once. Is there enough market or customer appetite to move it to amber, to put a bit more R&D into it? Can we then pre-sell it to a couple of users? It's going to have a bit more overhead. We give it to those users in like a closed beta. And so we've been selling our R&D the whole time. Our industry has a tolerance for waiting a month for something, which is great. But it's meant we've been able to be really intentional. And the thing that I've now learned is it doesn't get cheaper and easier to do R&D as the team gets bigger. It actually gets a lot harder. So when you're smaller, you don't have a full database architecture set up and you haven't built your own custom front end, it's much easier to spend half an hour spinning up some ideas and popping it in Tableau and showing it to a customer than it is when you've already built out all those systems. So really trialing and erroring at the beginning is important.
Yeah, it really highlights what I think is really the only advantage that startups have over incumbents, which is speed. And it also reminds me of, there's a great book, I think it's by Eric Ries, called The Lean Startup, which came out, I think, maybe 15 years ago or something. It's one of the seminal books about startups. But I think it's very much kind of in the DNA of how we think and talk about startups now. But it was quite a novel idea at the time, which was to sort of figure out the smallest atomic unit of the smallest kind of iteration you can make. Like, what's the lowest hanging fruit hypothesis that you can test, on which you can sort of iterate. And if it doesn't work, the product stays as a red product and never becomes a green product.
Raj, can I just add one thing? Because we were talking about cost. So I have to give a big shout out to AWS. So for the help,
Shout out to AWS.
A big shout out. It is, I'm not, yeah.
Keeping the Australian ecosystem in credits and beer since 2006.
Yeah. We seriously tapped into some of the credits we got, and a lot of help in access to experts, because sometimes, we are trying to solve, yes, we are inventing something in that part, we are new, but there are other things that are repeatable in companies like AWS would really know, for this problem, here's a way to do that. So we can focus on the thing that we want to work on, the real research, right? Not worry about how to data pipeline or how to store the data, etc. So yeah, that definitely helps.
Yeah, that's something I hear quite often. I think across the ecosystem, AWS is super generous with like their account executives and things like that. So definitely make use of that and talk to Lauren if you haven't already. Awesome. I think one other interesting thing to highlight on this panel is we have a group of panelists who've raised capital from sort of very different types of investors, from sort of Macquarie and Seek and W23, and overseas venture as well, just Neighbourlytics. Perhaps what sort of perspectives can you share on kind of how you made that decision to ultimately press go and partner with a particular investor? Maybe Jacqui, we can start with you.
Yeah, sure. So at the time when we were going through our Series A, we were talking to, there were kind of two different paths we could go down. One was VC. Airtree actually was the main player that we were in discussions with, and then Seek had also actually contacted us through that period. They'd signed up to the website, and it was just Tom and I and like one other person, so we saw every sign up at that time, and we were like, oh shit. Like, Seek are gonna build this product, like they've got this massive team, we're done. And then we just kind of watched it, and he posted a job that Simon Lusted, who found us, posted a job, and then we like micro curated it. We're like, called the sidekick, like, go, make sure you're on time, dress appropriately. And we didn't, you have to tell people these things. And that person arrived at Seek and arrived on time and got sent home because there was actually no work to be done. They just wanted to test out the product.
Wow, they were just kicking the tires. Do you remember what the job title was? Can you say?
It was like admin assistant. And we didn't contact, like in the background, we were doing all this work, but we just stayed silent and be like, the platform works perfectly.
Like, wow, it's seamless.
It's seamless, yeah. And then we invoiced them. Yeah, he's like, there's 3 hours. So that happened, and then after the job went ahead, then they emailed us and said we wanted to talk about the product, and luckily for us, they wanted to go down the investment partnership model, and they've always been very supportive of founder-led businesses and kind of know their place versus founder, which I think is super important for any investors to keep in mind. And then the other option was a venture capital firm, which had all of the, the experience in building startups and a broader ecosystem. So both were very good options, similar terms, similar round sizes. So it was pretty consistent in that sense. But ultimately, what we ended up choosing was the industry domain expertise. And we just found that the conversations with Seek were more about where specifically the contingent labour industry is going, as opposed to, I guess, how to scale businesses. And for us at the time, that was what we thought would kind of help us as our business, as well as like the strategic alignment with, they've got a customer base and a workforce already. So those strategic partnership side of things.
Can I ask Jacqui a question?
Totally.
how did you weigh up the pros and cons of going with a strategic investor that might have their own agenda or perhaps put exclusivity on the table versus a more third-party investor that's not going to bind you into that kind of stuff?
I don't know. It was, it was more a feeling thing. It was definitely a consideration because you'll be much more independent if you invested through VC as opposed to through a partnership. I think we felt like our chances of success would be higher if we went with Seek because of their expertise and the team we had talked to through the process. And that was probably ultimately what it came down to, and the alignment on the product that we wanted to take to market and what they had thought, where they thought contingent labour was going and staffing was going. So I think it was just we ultimately thought that that expertise would help us in our chances of success, as opposed to the expertise of a VC around capital and running a good business. It's a little bit different. And
we struggled with that when we were deciding on investors, because when we founded, it's when prop tech as a term became invented. And so all the property companies who have a lot of funds started backing startups as the thing they were doing and talking about and putting in the fin review. And it meant it was hard to be funded by them without becoming the Stockland startup or the Mirvac startup. And there's no way the other property companies would work with us if we were the Stockland startup. And also that was at the beginning. I think it's a lot more sophisticated now, but they were trying to invest in us like they were investing in a shopping centre. And so the legal reviews and the things they wanted to see about the company were totally ridiculous. Like, we don't have any of that stuff. We're a startup. Like, we don't even have desks, right? Like, literally doors and trestle tables where we are. And so that was tricky, but also it kind of burnt our customers, because at the beginning, say, a big early customer for us was Stockland. They rolled us out across all their communities and shopping centres, and then they wanted to invest in us. And then they're like, and we said no, which is super awkward. And then they're like, well, why would we be we're going to build it in-house. Like, okay, go for your life, building it in-house.
What's that? Flattery. Oh, imitation is the best form of flattery.
6 years later, they have not managed to build it in-house, and they've come back to us as a customer. But it's tricky navigating that space when a lot of your particularly corporate customers are trying to do things in-house, which is tough.
There's another really interesting thread that fell out of that for me, which is that so there's, I think, the next session is about sort of exits and how to think about, the promised land, if you will, of, exiting the business and getting liquidity for the founders and the team. A thing that often perhaps people come around to too late is, perhaps taking on a strategic investor very early in the process can sometimes limit your sort of exit options, right? Like if the natural acquirer of your business invests very early on, it just puts you on a different path to exit. There's no right or wrong answer, but it's just something that I think is really helpful to sort of think about earlier in the process rather than later. It seems like a sort of a distant, sort of far away thing that's hard to sort of plan for, but it's always helpful to keep in mind. Buddhi, any reflections on your fundraising journey, how you picked investors? Obviously, W23, which is the Woolworths venture arm, and Macquarie Capital were your investors.
Yeah, so it's interesting. I mean, as Series A is kind of, it's an experience because that's the first time as founders, in our case, Bob, who's the founder, that you'd interact with VCs and learn also, because, up to that point, you get seed funding, mostly from friends and family. And, in Sapia's case, because we were a pivot from a previous company, we had some existing investors who were happy to kind of support us and give another chance. That was great. So it became a thing. Like, we had an idea of the kind of investor we wanted for Series A, but just ideas, because we didn't know what we could, whether we could get that investor. For example, somebody who saw value beyond the revenue. Like, for most investors, the revenue, the ARR, and the growth trajectory matters a lot. That's great. It is given, but who'd see value in the vision that we are on, like around the data set that we are creating around natural language, and how the rest of the natural language kind of innovations are happening. Somebody who could see that vision. The second thing is somebody who can kind of help with the expansion into other markets beyond Australia. So it was kind of like I know for Bob, it was a full-time speed dating kind of situation for a few months. talking to these VCs and learning from all those interactions is like what I call reinforcement learning. So through that you learn and you change, and then you have first meeting and maybe sometimes second one, and you find there's no alignment. So that's how we got to after discussions, W23 was I guess because Woolworths is a customer of ours, they could really see the value. So there was, I think it's very similar to what Jacqui was talking about, seeing the they have their own stats to validate what was going on, so they could see the value. And Macquarie Capital was obviously their portfolio and their access to international markets. That was really good alignment. Yeah, so it's a learn and kind of change. I mean, because it's a new experience. You're talking to so many VCs. I think you will have to talk to many. That's my experience, and that's when you learn what they value, whether they'll be the right partner or not.
Were your initial intuitions about what's important in picking an investor right? Like, was it ultimately kind of the framework you landed on?
Yes.
Yeah, that's good.
Yes. And for example, like, for me, being the one who's kind of driving the science and the kind of data strategy, I'm keen to work with an investor who sees value in that, and we could see in the due diligence process, both investors, obviously W23, they had access already because they were using our product. And we could see also Macquarie Capital putting a lot of emphasis on the research we had done, the science, the publications. So they would see value beyond just the standard stats of revenue.
Awesome. And Jess, just quickly, you raised from a US VC, is that right? I imagine part of that reason was market expansion. Do you want to talk about that a little bit?
Yeah, so we, in preparation for our the Series A, we were talking to investors about at the end of or middle of last year. I just came back from maternity leave, so my co-founder actually did it. So I can't pretend it was me, but she did an amazing job. Don't have a baby while you're raising capital. It doesn't help you go to meetings. So, but we were looking at the right investors for the Series A, and a small boutique VC fund called Aliavia, who are Australians that run a fund in the US targeting female founders. And they don't require that you work in the US, but obviously have really great networks to get you there and help mature you there. They could see our going to the US strategy would really make sense. And they said to us, rather than doing a Series A, what if we just invest in you now as a pre-Series A, and we help you work towards getting Series A ready? And the big issue for us is, of course, because the global markets are all over the place and so uncertain, we just needed the dust to settle a little bit about what was happening on the global economy before we could really decide, are we going to Southeast Asia next or the US next? And we have early customers in both markets, really great early traction in both markets, but we can't do both post-Series A. We have to pick one. And so we just wanted a little bit more evidence and to work closely with a VC who's done it before to get that plan in place before we took the Series A. So they came onto our board straight away, are absolutely amazing. We're so stoked that it happened that way and feel very lucky that a US investor took interest in us and are helping us get that offshore plan in place when it's still early days on that.
That's awesome. I mean, I think the one thing that's coming out of this for me is this is no one path to get to a Series A. It's not like there's a shop you can go to and just get your Series A done.
Imagine.
They all sort of come about organically. Different investors care about different things. Markets are at different points at the time you're raising. Opportunities open and close, and it's always kind of shifting. We're going to switch to audience Q&A now. We've got some zingers here. So maybe we can start off with the question is, what mistakes did you make when fundraising? Things you would change if you could go back in time? It's a spicy one, but anything anyone's willing to share or talk about?
I mean, we don't have enough time for this question.
Yeah.
An easy mistake to fall into is that it takes forever to to capital raise. We've got two founders. We were both on it full time at the time that I wasn't on leave, and still it took. You'd think it's going to take 2 months, and it takes 9 because the tail of it is 5 months of contracts backwards and forwards before the cash actually, and then the financial year changes, and suddenly there's all these extra issues and. So it always takes longer than you think, but there are ways of time boxing the process. And so it's very easy to accidentally get drawn into the potential investors' timelines, and it's much better to start a raise by saying we are going to take expressions of interest and book meetings between these dates and these dates, who's of interest, and it allows you to go out to the investor market and say, in 3 months we are opening. Of course, they want to talk to you then and look at your pitch deck then, but you start to really know who is a meaningful investor before you even open. Otherwise, you can end up open for ages and not really know. It takes a long time for investors to show their hands and say, no, we really are interested in that. So time boxing the raise itself does help shorten it, but it will always take twice as long as you think, 3 times as long as you think.
Yeah, investors are pesky creatures. They need to be
We
like
love
very
them,
corralled and no, really, I think it's a really good point. Really setting clear expectations around timing. I think there was a question earlier about like how to create FOMO. I think like that's a good way to kind of show you're serious about this and create some urgency.
Well, a fast no is better than a slow yes or a slow maybe or a never getting to an answer. So that's a way of pushing a fast no. So
yeah, I love that idea, because when we were raising, it was very much on the investors' timeline. And I think one lesson was from a seed is that like you can waste a whole lot of time with people who are, I don't know, want to be seen in the community but not have any meaningful intention to invest. And there's some pretty like funny pictures we've made by people's pools in Brighton and at people's parties that we thought were going to be investors, and just in hindsight just a complete waste of time, which I'm sure everyone here has probably had a couple of those experiences if you're early stage trying to raise.
Yeah, I think definitely do your research on investors and like make sure they're legit. I think there's a lot of people who have like investor on their LinkedIn who maybe slightly more dubious. But that's a good one. And there's probably another thing to pull out there, which is around timelines of fundraisers. So typically, I think strategic or venture fundraisers typically take anywhere from a few weeks to 2 months. And your strategic ones tend to take a bit longer. Are there any kind of rough timelines you can share in your experience, like a couple of months? Like it's more of a dating process. They're sort of getting to know you over a period of a few months, right?
Yeah, I think ours with Seek was about 6 months, I think. Yep. Yeah, I don't know now we can, because we've raised multiple rounds with them. It can be a bit quicker. But I can't remember where I was going. Yeah, I think that the timelines around like setting your cash burn and stuff, that's obviously super important to know, and also have a plan B if it does fall through. You don't want to be in a precarious position where you're kind of forced to raise capital when you wouldn't, you don't want to at that time.
Yeah, the kind of rule of thumb is you want to sort of start this relationship building and conversations with investors maybe 6 months, 4 months before you're sort of out of cash to give the process time to run its course.
In the early stages, we were kind of, I know Pete Williams is on a panel tonight here, I believe, from Deloitte, and he was an early investor in Sidekicker and worked with Tom at Deloitte, and Tom's my co-founder and CEO. And that was like 12 months of us doing starting the business and providing updates to this. We had a list of early stage investors we wanted to invest. We'd give them updates. It was 12 months before actually getting any money from any of them, because they wanted to see, you're not going to quit, that you're actually getting somewhere. So that it's like relationship building and proving yourself, I mean, is super important, because, money is very valuable, and it's opportunity cost for investors to invest in you versus someone else. So you don't take that lightly.
Yeah, for sure. We have another question here, which is a pretty broad question, but we'll give it a crack. What are the key things to have in place in the business before going for Series A? Are there maybe 1 or 2 sort of things that you can share that maybe you felt like once you had this, or you crossed this kind of threshold, you were in a much better position, you were sort of maybe getting different responses from investors? Any kind of learnings you can share there?
So I would say it's that repeatability, that you can repeat the sales, and you've understood that, what your target market is, or the ICP, your ideal customer profile is very clear. And that you could see from how you pitch and the conversion rate with customers. And also, having some customers or strategic customers, like in our case, we've had retailers like Bunnings and Woolworths come on board. So that shows that's real strong signaling that, these large organizations are happy with the product. So that's a good time. Then again, that's a good time to take that and capitalize on it. Yeah, so until you convert some of them and until you really show that your product is validated, especially given the nature of the product, in our case, it's an AI-based product, it's a predictive product. So you got to show the signals that it's working and it's working for customers that people would trust. And that then helps in repeating elsewhere. So that's a good signal for the investor.
And I think the lesson there as well for founders is like, keep really good data. Like it's incumbent on you to really tell this story when you're getting to Series A, track as much as you can about customer engagement in your app. So you can tell that story, we've got these customers there logging on every day and using this product. I think that's really good and often a mistake we find. I think that investors expect a kind of level of professionalism when it comes to Series A that's we can sort of overlook when we're at the seed stage. And having really good data is one way to kind of tell that story.
Something else that's really easy to overlook, and I think perhaps a lot of investors don't even ask about it, but would trip you up if you don't, is having the team management and workload systems in place for any type of acceleration of the company. Because you can say, well, give us $20 million and we'll hire 15 people to do these jobs. But if you don't have a recruitment process, a staff onboarding process, a way of getting those people to map their work, link it into the quarterly goals, track where it's going to, look for where that performance isn't working, you literally cannot do the job. And so you have to have that stuff sorted, and you can't build it while you're recruiting the people. You have to have it in place beforehand, or else you actually can't execute. No matter how much money you have, you can't organize the people to do the stuff they need to do. So. Yeah,
and there's a sort of sense of urgency. Like once the Series A closes, it's like, okay, this is game time. Your investor's going to come to the board in 3 months' time, and everyone's got around the table and agreed on a particular vision. You want to really make sure that the business is ready to sort of.
And you can't say in your forecast, once you give us the $20 million, it'll be 6 months until you see an uptick because we haven't gotten the HR process. And it's like, it can't happen.
Yeah, it's a hard pitch. Awesome. Jacqui,
we definitely didn't have that in place. I'm still thinking, do we have that in place?
You were hiring off Sidekicker.
Yeah, we were building the plane as we were flying the plane, definitely. But for bigger raises, like more recent raises, absolutely. It's super critical because, yeah, you definitely don't have any time to wait after you've got the money in.
Awesome. How are we doing for time, Jane? Fantastic. We kind of touched on this a little bit. I think Buddhi gave an answer to this. Maybe, I don't know, Jess, Jacqui, how do you know you've found product market fit? I think we talked a little bit about how it feels. You're getting pulled by customers. Anything to add to that? I know we've touched on a little bit, but this one got a lot of votes. So people in the audience want to know.
Product market fit, the elusive product market fit. I think, Buddhi, you use the word repeatability and consistency. Like that's a big tick for product market fit. If the same thing happens over and over again, that's something you can scale and you can work with. For us, it was I think, again, the metrics are super important. So if you know what you're looking to see and what you're actually trying, what metrics are important for your business, then you can actually measure product market fit. And you mentioned like the investors want to see more, more sophisticated data. I think in startups and in this day and age, there's a real problem with just data overload. Yeah. Like we measure everything. Everyone in the company can see all the metrics. So how do you even know what you're trying to move if you've got such a broad set of metrics? So as a founder, it's probably the most important thing for you is to know what is the 2-3 metrics that we need to move for my business, specifically my business, to be able to scale and grow and succeed. And if you get them wrong, then you're focusing on the wrong things. And then those metrics are the numbers that will move if you get product market fit. For us, early, it was repeat use. It was rehire. It was like, is this customer posted 3 times in a row? And we had, like, this is how small it was. Like, there was a customer, property builder in Richmond. They were building an apartment, and there wasn't a traffic light system set up there yet. So they hired a psychic every Saturday for 4 hours to stand and press a button so the lights would change so the cars would drive in. And you had to wear a top hat, and like everyone who's early Sidekicker has done this job and just stood there for 4 hours, like rain, hail, shine, pressing the button. But every Saturday, that was 4 hours of work that came like through the system, through the product. And that was like before, that was early stage, like seed. But that was an example. That was like, okay, well, if you do that, 1,000 with 1,000 customers, then you've got recurring revenue and you can scale. Whereas when someone, picked up the groceries, got someone to pick up the groceries and drop them off, and then never came back, we never saw them again. That's not a scalable bit. That's not product market fit unless you've got a lot of money to build brand. But so knowing your metrics is number one, and then actually measuring your early stage traction against the metrics that are important.
Yeah, that's awesome. Without that, it's sort of like, I think of it like putting water into a leaky bucket, right? Like you're just acquiring the same customer over and over.
Yeah.
In that case, so you want to make sure they're coming back and the retention's good. You're going to say something, Jess?
Yeah, for us, because we're a software subscription where our users subscribe to our data and then can use it on their different projects. And but we have a logo relationship, so we'll bring on Lendlease or Stockland or whatever, and then they've got assets like a shopping center they onboard, and then that shopping center has 30 people that are involved in it. So we have lots of levels of users. So a lot of investors have asked us to talk about churn. And churn isn't really the thing to look at. Like churn looks great because we pretty much never lose a logo. Once they've started with us, they tend to stay on, but it's not a lead indicator of what's actually happening with. Yeah. And so, but even what we realized is that we actually have a whole lot of secondary users that the person that has the login is doing screenshots and emailing stuff to someone else. I'm like, hang on, we have this whole network of secondary users that we don't even have email accounts for. So the platform we're building now is a light product that you can just share with, so they all can log in and see. It's better if you can actually interact with the data rather than just see a screenshot in an email. And so for us, that's the type of metric we're tracking closely, is what does sharing look like? What are they doing with that? What do logins look like? And that's a better way of understanding exactly what product market fit looks like and demonstrating that to investors.
That's awesome that you were close enough to the customer to pick up on that. That's a really hard one to pick up on, right? And it tells two very different stories.
Well, they kept asking us, can you just put it all in a PDF for me? And we're like, oh, we're a data visualization product and we've got a beautiful UI. How dare you try to print screen it and put it in a PDF?
We just print this and highlight it. Yeah.
That's right. That's like they say. Yeah, they say PDFs is where data goes to die. Like actually that is what happens. And so we're like, okay, let's figure out whether they're screenshotting it. So we were able to track that and we saw, oh my God, they're screenshotting it all the time. Okay, let's fix it. Yeah.
Amazing.
It's a download button. You need the download button.
Sorry, this feature hasn't been built yet, but thank you for.
Fantastic. Well, I can feel Jane giving me eyes in the back of my head. So it's time to wrap up. Would you please join me in putting your hands together to say thanks for our wonderful panelists?